Hello, everyone, and welcome to today's webinar. In order to respect everyone's time, we will begin, though we expect more people will be joining. Today's webinar is the public launch of version 2 of our financial institutions near-term criteria. And we will be presenting this webinar twice today. So if you miss today's this session, you can also join a session later today. My name is Nate Aiden, and I'm the head of financial standards at SBTi. And I will be joined here today by Howard Shi, who's the technical manager for financial institutions at SBTi, and who has led the work on updating these criteria that we're discussing today. Just some brief housekeeping notes before we get into the content. This webinar is being translated into Chinese, Spanish, and French, and so there should be a button at the bottom of your Zoom screen here that allows for interpretation and captions. So please use that if you would like to switch to another language, one of these 3 other languages. We also have a Q&A box at the bottom of the screen, so please feel free to add questions as we go. And also recordings of these webinars will be published to the Science Based Targets Initiative's YouTube channel, and links will be freely available. So you can always go back and re-listen to anything that we go through quickly here today. The webinar has 2 basic parts to it. First, I'll give some background on these criteria and what we've done. And then Howard will go into detail on the actual financial institutions near-term criteria. And then we'll close it out at the end. The webinar is expected to run for an hour. And as I said, we welcome questions in the Q&A box. So in terms of background, as many of you know, the Science Based Targets Initiative first published our criteria and framework for financial institutions back in 2020. And that was the culmination of a 2-year process to develop those criteria and methods. And we've learned a lot in the past 4 years. And so this update is built on that 2020 framework. And these are 5 of the sort of imperatives that we've addressed with the update. So in 2021, the Science Based Targets Initiative published a corporate net zero standard. And so this update aligns with that with the corporate net zero standard in terms of the scope 1 and 2 and category 1 through scope 3, category 1 through 14 components. The second is enhancing clarity. So there was a lot of innovation that happened with that 2020 framework, and we've refined it here to enhance clarity and improve the usability of the criteria for financial institutions. We've also increased minimum ambition for scope 1 and 2 targets to 1.5 degrees, consistent with the corporate net zero criteria, as I mentioned. And finally, we've added fossil fuel activities and a fossil fuel method that we'll describe. So those are some of the high-level changes that we've made. In terms of process, we've been working on this update for a couple of years now, and you can see some of the key milestones here. So we began updating this after the publication of the corporate net zero standard, and then we did 2 consultations around this draft. So the first was last summer of 2023, where we shared some documents for public consultation. We were pleased to have lots of feedback, which we then took into account here. We then presented to the Science Based Targets Initiative's Technical Council on what we were planning to include in this updated version. And then last winter, from November to January, we did pilot testing with about 30 financial institutions that actually used these criteria before they were made public, just to assess the usability and do some checks on our side on the criteria before we published them last month. Finally, we went back to the SBTi Technical Council and Board to get approval for this update. And this is all the new standard operating procedure that the Science Based Targets Initiative has introduced to become a more formal standard setting organization. In terms of effective dates, the idea is that this new FINT v2 set of criteria will be sort of brought into effect over a 6-month period during which financial institutions may choose between the previous version 1.1 criteria and the new version 2 criteria. After those 6 months have passed, then version 2 will be the only option for financial institutions to have targets validated by the Science Based Targets Initiative. At this point, we have 110 financial institutions that have been validated using version 1.1 of the criteria. Those targets remain, and there's no need for those financial institutions to update or redo their target with the publication of version 2 here. If the financial institutions choose to do so, of course, they're welcome to. And the idea is that SBTs are valid for 5 years, after which they need to they need to be assessed against the current criteria at the time of that new validation. There's a suite of documents that we've published with these criteria. So the first is, of course, a criteria document itself. And then we've also published a new target submission form, which is essentially a spreadsheet that financial institutions or other stakeholders can fill out for the financial institution to be validated. We have a document that's been updated, which is what we call the criteria assessment indicators. And this explains how the Science Based Targets Initiative target validation team uses the criteria to assess the information in the target submission form. So it's all very transparent here. We have commissioned translations of the criteria document, which we expect to be published in the next few weeks, and those will be available through the SBTi website. We also have what we call a main changes document, which goes into detail about the differences between the version 2 of these criteria and version 1.1, the previous version. In 2020, we published a broader document that we called the guidance document. And the purpose there was to explain how financial institutions can go through this process, to describe the methods that were included, and also to provide 8 case studies from financial institutions that had used the various methods and data sources. We've updated that document, and in the vein of becoming a more formal standard setting organization, we have renamed that document an explanatory document. So these are the 5 documents that are available now with the translations forthcoming. In terms of where we're going, there are 2 large projects that the Science Based Targets Initiative is working on for financial institutions. The first is near-term criteria, which we first published in 2020. And this is obviously the update of those. The second is a net zero standard for financial institutions. And that's something that we've been working on for the past couple of years. And we are aiming to have a consultation draft in the next few weeks that explains sort of the next step for the net zero standard. The table on this slide between the near-term criteria, which we call FINT v2, versus the net zero standard, which we call FINS with a Z. So in terms of the scope of activities, the major difference here, as you can see, is that we've broadened beyond the FINT v2, which just covers investment and lending activities, to also include capital markets and insurance underwriting for the FIN standard. So this is forthcoming for the FIN standard, but what's available now is FINT v2 on the left. Second, in terms of time frame, as you would expect, the FINT criteria are near term, so they're just up to 10 years at this point, whereas the FINS standard is expected to go farther out insofar as most financial institutions can't actually achieve net zero within 10 years. The methods and metrics, as we'll describe here in detail, we have 3 that we included in the 2020 framework, and we've added another fossil fuel finance targets method with corresponding criteria that we'll describe. For FINS, we are pivoting so that we're not just anchored to those incumbent methods, but we're looking more broadly at climate alignment, emissions intensity, and policies. And so this is a new approach that we're exploring with the FINS standard, and we'll be consulting and pilot testing on in the next couple months. In terms of coverage, we did a bottom-up asset class-based approach in 2020, and you'll see that we've elaborated on that with the FINV2 update to make it a little bit more clear and a little bit more flexible in terms of identifying the most material activities and allowing some discretion with the financial institution to make sure that they're covering the most emissions-intensive investment and lending activities. Finally, as I mentioned, for FINV2, we have a 6-month period now where financial institutions may choose between the previous version 1.1 and version 2, after which it'll be FINV2 only after the 30th of November of this year. For FINS, obviously, it's earlier in the process, and so our expectation is that we will be able to publish something in Q1 of next year, subject to review and approvals from our technical council. So that's just an overview of sort of the two major work areas for SBTi with financial institutions. With that, we conclude the background, and I will hand it over to Howard to begin describing the FINV2 criteria in detail.
Thanks, Nate. So this next slide gives a general overview of the process for a financial institution to set SBT. And we can go over this step by step in the next several slides. So the first step is for the FI to define its organizational boundary, compile its emissions inventory, at least for its operations. The second step is then for the FI to determine the ambition of its scope 1 and 2 targets. So here, FIs can set absolute reduction targets for scope 1 and or scope 2 emissions. And they also have an option to set a renewable electricity procurement target for scope 2. The third step is then for the FI to decide whether it would like to set optional targets on its scope 3 categories 1 to 14 emissions, such as from business travel. And to be clear, this is optional. Meaning scope 3 category 1 to 14 is optional for FIs in both version 1.1 and version 2. And the reason for this is that for FIs, as you all know, scope 3 category 15 is the most material for FIs. This optionality is meant for FIs to focus on their most material emissions, being category 15. So here, category 1 to 14, they can set absolute reduction, intensity reduction, and engagement targets to cover the categories 1 to 14 emissions. In terms of changes between version 1.1 and version 2, the following have been made to update criteria to align with our corporate net zero standard criteria. So first, the time frame of scope 1 and 2 targets have been reduced from 5 to 15 years to 5 to 10 years. Second, 1 and 2 targets has been increased from well below 2C to 1.5C. And what this usually means is a minimum 4.2% linear annual reduction in absolute scope 1 and 2 emissions. So for example, if you're setting a 10-year target, you would need to set at least a 42% reduction in absolute emissions. And then third, guidance on base years and forward-looking ambition have also been explicitly added for all scopes. So for example, the base year can be up to 2015, but of course, the most recent year is recommended to be used. And if the base year isn't from the last 2 years, then data from the last 2 years would need to be provided in addition, since targets that have already been achieved cannot be submitted to the SBTi. Then the fourth step is where we start going into scope 3 category 15, and that's where the FI will need to identify all of its relevant and required asset classes where targets must be set. And if you're familiar with our criteria document, there's a table 1 there that summarizes which financial sector activities are currently required, optional, or out of scope in terms of being covered by targets. It also indicates the minimum coverage needed for required activities, as well as the target setting methods that can be applied to each activity, which we'll go over in later slides. And target setting methods essentially is the way or formula that is used to determine required threshold of ambition for targets. In terms of changes from version 1.1 to version 2, Table 1 has gone through a significant update. So in particular, more granular specifications have been added. So for example, you can see here on this slide, a separate real estate asset class has been added, just so there is more explicit wording around the coverage requirements for this asset classes. A few more examples of the additional specifications in Table 1. We've added more clarity on investments via funds. So here, generally, the coverage requirements are based on the underlying holdings. So for example, if an FI invests in a fund that invests in corporate bonds, which is a required asset class, then the targets on these fund investments are also required. Whereas if a FI invests in a fund that invests in sovereign bonds, which are currently out of scope, then these fund investments are also out of scope. And then lastly, if a FI invests in a fund of fund, meaning a fund that invests in funds that then invests in funds or assets, so you can see these multiple layers, then targets on these would be optional, again, given the multiple layers involved. And then maybe just a last note on this slide, securities in the trading book are now also optional. And this is roughly in line with other initiatives. Another example of changes to Table 1, we've added more explicit requirements on asset management activities and also added some definitions to the criteria for clarity so that we're all basically on the same page. So just to run through 3 of these definitions. So discretionary mandates, that is where the FI can make investment decisions for third parties without seeking that third party or client's approval. So in this case, the coverage requirements would depend on the underlying holdings. So if the underlying is required, then these managed assets are also required. Second, for advisory mandates, that's where the FI can provide advice and make some investments, but they are subject to the third party instructions or approval. So these would be optional if the underlying is required optional, and then they would be out of scope if the underlying is out of scope. And then lastly, execution-only mandates. That is where the FI executes investment instructions only. So they just carry out whatever they are told to do. So these would be out of scope regardless of the underlying holdings, given the lack of control and influence over the investments. And then I believe one more example changes to Table 1. So for corporate loans, a few changes have been made in version 2. So we added some flexibility. So first, FIs can now choose to use the loan outstanding amount, loan commitment amount, or exposure at default as the numerator of the attribution factor that they use to calculate finance emissions for corporate loans. Secondly, flexibility has been added to the calculation of the 67% minimum coverage requirement for long-term loans to other sectors. And then lastly, for SME loans, here FIs will need to use the SBTi definition or the relevant regulatory definition of an SME to determine the applicable coverage requirements for SME loans. However, for target validation, for companies that want to go through the SBTi streamlined validation route, companies will need to meet the SBTi definition of an SME. And that's just to reflect the recent update to our definition. And now these companies that are eligible, they can also choose to set targets through the standard validation route. So this slide just gives some more details on the second change that was on the previous slide in terms of adding flexibility to the coverage requirements for corporate loans. So I'll just pause here maybe and check some of the questions. What does coverage refer to? So by coverage, we mean the extent that targets must be set, and that can be based on finance emissions or a financial asset metric such value or under management. Updates on private equity.
Hi, Howard, thanks. So for private equity, we have the current document, which we published in 2021, and that holds for the time being. SBTi is planning to publish the fin standard, as I said, next year. And the thinking is that we may have substandards that follow the broader fin standard, including one covering asset management and private equity, but that remains to be determined. So for the time being, the existing guidance is what financial institutions and private equity firms should use.
Thanks, Nate. Another question, I guess asking to go over this particular slide. So under version 1.1, long-term corporate loans have a minimum coverage requirement of 100% for electricity generation, 95% for fossil fuel, and 67% for commercial real estate, and then 67% for all other sectors. So based on feedback from the public consultation and pilot testing, some FIs said that they struggle to achieve the latter 67%, just given the composition of their portfolios. So under version 2, FIs can now include any mix of loans shown here in the calculation of the 67%. So maybe example might help. So before, if a bank had, say, $10 of loans to fossil fuel companies, $10 to real estate, and $10 to all other sectors. So before, that bank would need to cover $950 of loans to fossil fuel, $10 or no, $66.70 to real estate, and then $10, sorry, $950 to fossil fuel, $670 to real estate, and then $670 to all other sectors. So that's a total of around $23. And then under version 2, FIs can now meet the coverage requirements if they just cover 67% of that $30. That would be, I think, just over $20 to all loans. And that is as long as their targets cover $950 of fossil fuel and $670 of real estate as well. So with that, maybe we'll move to the next slide. So this is also one of the bigger changes in FINV2, and that's the addition of a coverage floor and materiality exclusion option. So the first raises requirements, and the second one does add some flexibility. And if you read the criteria, it may sound complicated at first, but hopefully this process tree will make it a little easier to understand. So the first step would be for the FI to quantify all of its activities that are considered required and or optional for table 1 that we just went over. And they will need to use a specific metric. So they do have the option to choose finance emissions or a financial asset metric. So again, that's loan value or invested value or assets under management, for example. So once the FI has quantified its required and optional activities, they then need to define its portfolio target boundary denominator. So this denominator will include all required and optional activities with an option to exclude certain activities in the asset management or consumer loan asset classes, but only if they are a very material asset class. So once that denominator has been defined, then the FI will need to set targets on 67% of that denominator. So what it would first do is to set a target on all required activities first, and then check, am I meeting that 67% requirement? So if I'm setting targets on all required activities, and I also meet that 67% coverage floor, then you are meeting the minimum requirements. However, if you're setting targets on all of your required activities and you don't meet that 67% floor, then you will need to go back and set targets on additional activities until you meet that 67% threshold. In terms of the materiality exclusion option, so these can be applied to entire sub-asset classes that are non-material, so meaning 5% or less of the portfolio target boundary. And they also cannot involve any fossil fuel activities. So for example, if FI has 99% of its assets related to corporate loans, and then just 1% in listed equity investments, for example, they now have the option to just focus on its corporate loans. And they won't be forced to set targets on their non-material activities. So not forcing them to chase the long tail, for example. So given that this is a new criteria, we can pause for some questions here. Nate, maybe I'll give this one to you. Is this 67% requirement and 5% exclusion option a V2 update?
Yeah, thanks, Howard. So these are new in V2, and financial institutions may choose for the next 6 months between version 1.1 and version 2, but they're mutually exclusive. And so it's not allowable to choose some aspects of V1.1 and version 2 and combine them yourself. No cherry picking is allowed here. So if financial institutions choose to use version 2, then it's the entire set of version 2 criteria.
Thanks, Nate. And then I see a question, I guess, asking about the thinking behind the 67% number and the 40% threshold in step 2. Yeah, so I guess maybe some background on those numbers. So we kind of draw these numbers from the corporate net zero standard, where that have scope 3 emissions that are more than 40% of their total scope 1, 2, and 3 emissions, then they are required to set targets on at least 67% of their scope 3 emissions. So they may not be exact parallels, but the numbers here that draw from those numbers that were set on the corporate net zero standard. So 40%, if it's material, then you'll need to cover your optional activities in asset management and consumer loans. And then generally that 67% was just seen as a material threshold to have minimum coverage requirements set on. And then just on the 5% exclusion option, that also just draws from significance thresholds that are provided for scope 1 and 2 under corporate net zero standard, as well as scope 3. And then another question, is the 67% threshold on the entire portfolio or per asset class? So the first step for FI is to figure out all of its required activities, and then they need to set targets that meet those specific asset class requirements. And then after that, they'll need to check across their portfolio target boundary if the targets there cover 67% of the portfolio target boundary. So it's kind of a two-step process where one, you have asset class specific requirements, and then now we also have this kind of cross portfolio minimum coverage requirement. So with that, maybe we'll move on. And then yeah, I see some more questions in the Q&A. We'll try to get to those, but we'll just move along for now and then pause later. So I'll turn it back to Nate to go over some of our target setting methods.
Thank you, Howard. Yeah, and just to reiterate Howard's points here, the optional activities are required to be included here in order to make up the 67%. And part of the rationale there is that we were having some SBTs previously that had very low coverage levels, and that's not ideal for the financial institution in terms of actually addressing its climate impacts. And so that's part of the design here that Howard's been describing for FinFET2. So I will just walk through the three sort of incumbent methods that I think many of you are already familiar with from the 2020 framework, but just a reminder and an explanation of how they've been updated. So the first method is what we call the sector decarbonization approach. And this is something that SBTi first developed back in 2015 and published an article about it. And it's physical intensity pathways for different relatively homogeneous sectors. So you can see the 11 sectors here in the slide. So aluminum, aviation, buildings, cement, chemicals is forthcoming. There's flag guidance, land transport, power, maritime shipping, iron and steel, and oil and gas is, of course, forthcoming. The two that we find financial institutions use most often are buildings, whether it's residential mortgages or commercial real estate, where it's grams CO2 equivalent per square meter of built space, and of course, electricity generation project finance. In terms of the updates within FinFET2 to the SDA for financial institutions, the first one is aligning with the corporate net zero standard in reeling back the time frame from 5 to 15 years to 5 to 10 years. The second is, as I mentioned earlier, increasing that minimum ambition level from well below 2 to 1.5 degrees for SD application. We also had a number of situations where financial institutions were investing in renewable electricity already. And so we had an option to maintain that level of investment in clean electricity. And that's something that is exclusive to the financial institutions criteria at this point. In terms of the second method, which we call SBT portfolio coverage, the idea is that is our counterparties to get them to set science-based targets. And when we first introduced this in 2020, it was new, but it's proven to be quite popular, especially among asset managers and asset owners. And so we have continued to update this. And because of the orientation of many financial institutions and some of our peers around 2030 as a target and benchmark year, we've stretched that 5-year time frame for portfolio coverage to include 2030. And so it's sort of 5.5 years for the next 6 months or so, and then it will revert to a 5-year time frame for the SBT portfolio coverage targets. And the idea is that this isn't as chunky, if you will, as physical asset investment that's required often to reduce physical intensity. And so there's a shorter time frame for it in terms of accountability and early action. We also now allow for additional long-term portfolio targets to be included in the SBT. One other update that we made is that financial institutions shall use the same base year for all of their portfolio coverage targets. If they have different portfolio coverage targets for different asset classes or areas, their portfolio, then they need to use the same base year. And this is just for assessment and communication purposes. Finally, for temperature rating, this is a new method that we introduced back in 2020 with a Python tool and a write-up of the method. And again, it's proven popular among some groups of financial institutions. And so we've kept that here, but we've raised the minimum ambition from well below 2 to 1.5 degrees for the scope 1 and 2 components of the target. And for the scope 1, 2, and 3 component to well below 2 from previous 2-degree minimum threshold here in terms of ambition. So we also are starting to allow third-party data providers in terms of the temperature scores, as long as they are consistent with that published SBTi method and tool. And so that's something that we've introduced for additional flexibility. And because some financial institutions were finding it difficult to use the Python tool, it's rather data intensive and it requires some technical skills to use the tool. And so that's a change here. And again, consistent with SBT portfolio coverage, we're allowing 2030 targets beyond the 5 years from today. And then again, consistent with the SBT portfolio coverage targets, we're requiring the same base year for temperature rating targets. I will pause here to see if there are any questions.
Thanks, Nate. Maybe I'll pass this one to you. Do you expect financial institutions to use specific scenarios, such as those provided by the IPCC or IEA when setting their targets?
Yeah, so we do expect referencing published 1.5 degree scenarios, but generally we are flexible in that the target validation team will assess, for example, SDA targets, and as long as the target submission meets our minimum ambition thresholds, then financial institutions may use whatever basis or scenario is most appropriate for them.
Thanks, Nate. And then maybe I'll pass this one to you as well. Can we use CREM for real estate targets?
Yeah, so there has been a consultation recently where SBTi partnered with a group called CREM on building scenarios in particular. And so the new SBTi building sector guidance does integrate CREM scenarios. And once that's finally approved by the Technical Council and published, then that will be available, and we expect it to be available shortly.
And then a question here, if the target submission year is 2024, can the target year be set for 2030? So I can take that one. So for the SDA, the time frame can be 5 to 10 years. So yeah, if you submit this year, 2030 is within that 5 to 10 year range. If you're asking about portfolio coverage or temperature rating, Nate mentioned that we now allow target years of up to 2030 or within 5 years. So yeah, if you submit this year, portfolio coverage or temperature rating target, the target year can be 2030. Yeah, so hopefully that answers. And then Nate, maybe I'll pass this to you. Is there a list of third-party temperature rating providers that are accepted to the SBTi?
Yeah, good question. And at this point, we don't have a public list. And it's a debate within SBTi in terms of whether that's really an appropriate role for the initiative in terms of having sort of a public validated list. There's a few questions. One is, the dynamism of these temperature scores and how often that assessment would need to be done. So it's something that we're looking into, and we do plan to return to temperature rating in the Fin standard development process. In the meantime, I think the self-assessment by the financial institution and the target validation team is what we're going with.
Thanks, Nate. So maybe we will move on to the fourth target setting option. So here in Fint v2, we've added a new option called the fossil fuel finance targets method. And this is to help address FI's fossil fuel related activities. And this involves 4 key things, and that's the disclosure, halt, transition, and phase out of fossil fuel related activities. And just to be clear, FIs must set targets on the fossil fuel sector. And what is optional here is which method you decide to use to cover the fossil fuel sector. So this is a new option that you can use now. And before we get to the 4 groups of criteria, we'll just set a baseline in terms of some definitions. So in the criteria document, you'll see a table 2 that does have more details about the boundary and the scope of this method. But just as a baseline, for coal companies, FIs will need to define those as companies listed in the global coal exit list. And that's a list that's compiled by Ergovold, the NGO, and or companies with 10% or more of revenue from the coal value chain. And then similarly for oil and gas companies, FIs will need to define that as companies listed in the global oil and gas exit list. That again is compiled by Ergovold. And all national oil companies and or companies with 10% or more of revenue from the oil and gas value chain. Now, in terms of defining the value chain, here FIs will need to disclose the definition that they are using. And so they will need to provide the industry codes that they are using. So for example, for coal, we've added some guardrails there where the value chain has to include at least the upstream segment. So that's exploration, mining or extraction, and development or expansion of mines. And the minimum requirement is to cover thermal coal, as well as coal-fired power plants. Of course, we recommend to go above the minimum requirements and cover met coal and the midstream and downstream. And then similarly for oil and gas, the minimum requirement is to include the upstream segment. So with those definitions, we'll go through the 4 groups of criteria. Must publish a policy prior to target submission that commits to disclose 2 things. So one is a financial metric for all of the FI's activities that are related to projects and companies in the coal sector, as well as the oil and gas sector. So for example, that would just be the dollar amount of loans or investments and AUM Or for insurers, for example, it could be the underwriting premiums that are draw from the fossil fuel sector. And then second metric to disclose would be emissions. So that would be scope 1, 2, and 3 emissions that are related to the FI's required and optional activities in the fossil fuel sector. Second group of criteria, the FI, again, will need to publish a policy prior to target submission that commits to stop all new financial activities that are related to the following three things. So first, that's projects and companies involved in new coal mines, extensions or expansion of coal mines, or new unabated coal-fired power plants. And that wording, as you may notice, draws from IEA wording, as does the second group, which is new long lead time upstream oil and gas projects and midstream infrastructure dedicated to them. And then third group of activities that FIs must commit to stop providing new financial activities to. That would be companies involved in the group number 2 oil and gas projects. But on this, there is an option for FIs that want to continue engaging fossil fuel companies. They can commit to halt new financial activities provided to companies that are dedicated to the group number 2 oil and gas projects. But if they choose to use this option, their activities generally would still be covered in the transition target, which is on the next slide. So third is that FIs must set an absolute emissions reduction target of 5 to 10 years on the scope 1, 2, and 3 emissions from required and optional activities that are related to upstream oil and gas projects and companies. Here, the minimum target emission level is based on the cross-sector pathway. So that's the same as with scope 1 and 2 targets that we mentioned towards the beginning. And that's the 4.2% linear annual reduction. And then FIs will also need to set a transition target on coal projects and companies if their phase-out target, which is the next group of criteria, is over 5 years from target submission. So yeah, on the phase-out target here, FIs again will need to publish a policy prior to target submission that commits to phase out all financial activities related to coal projects and companies by the end of 2030 for those operating in OECD countries, and then by the end of 2040 for all coal projects and companies, unless they are for decommissioning purposes. So this is a totally new target setting method option. So I'll just pause here to go through some questions. And yeah, just to reiterate, FIs must set targets on fossil fuel sector, but FIs have the option to use this particular method or not. Nate, maybe I'll pass it to you. Just to clarify, if this method is additional to the existing ones.
Yeah, thank you, Howard, and thanks for the question. So the idea here is that financial institutions must cover all of their fossil fuel related activities. And this new fossil fuel finance targets method is one option. If, for example, they have asset management activities, they may use, once SBTi actually has established and published the oil and gas method and guidance. So at this point, portfolio coverage is not an option in reality because SBTi is not yet published or validating oil and gas company targets. So the intention of this new method is to provide a fossil fuel specific option for financial institutions that can be used now and is not contingent on the forthcoming SBTi work in that sector.
Thanks, Nate. And then maybe pass this to you as well. Why do you leave the choice for the company scope using the GCell and GOGOL would be simpler? Both are very comprehensive, robust, well-known, and used.
Thanks. Yeah, indeed. We find those Ergewald lists to be very convenient. But we also understand that some financial institutions have done the analysis themselves and are tracking these percentages and thresholds closely for their own purposes. And so we want to enable that direct tracking and usage as well. When we did the pilot testing last year, we found that we had sort of a first preference for quantitative thresholds, but that there were some financial institutions that didn't have access to all of the granular data. And so the intention with the Ergewald lists is to have an off-the-shelf, easier way to do this screening. Also because the Ergewald lists separate out those companies that are expanding capacity for the halt provisions that you mentioned earlier. So those lists are very convenient for that purpose as well.
Thanks, Nate. Then maybe we'll take one or two more questions. Point of detail, but does the coal value chain only cover thermal or also met coal? I can take that one. So the coal value chain must cover at least thermal coal, but of course we encourage FIs to go beyond the minimum requirements and also cover met coal. And then for the HALT criteria, what is meant by new financial activities? So yeah, in terms of new financial activities that FIs will need to commit to stop providing to the three groups. So for fossil fuel projects and companies that FIs aren't already involved with, in that case, FIs can provide any required optional or out-of-scope activities. And then for the projects and companies that FIs are already involved with, here FIs would commit to not provide any new or additional financial activities. So maybe example here. So if you already hold, say, 30 shares in a coal company with expansion plans, you can continue to hold those 30 shares, but you can't buy any more shares than that. And yeah, if you do sell 10 of those shares at a later point, then you'll need to, you can hold those 20 shares, but not add to that 20 thereafter. And then maybe a second example for loans. If you are providing a $60 loan to that coal company, then you can't provide any new loans or renew that $60 loan past the original maturity date. So I think we have 5 minutes left, so maybe we'll just move on to next few slides. So with those 4 methods, the FI will need to develop clear and quantitative public target language in step number 6, and they can use the updated target language template, which is in table 3 of the criteria document. So there, they just need to use the template, depending on which target setting method they're using. And then they'll also need to provide 2 other things. One is just disclosing the percentage of covered by targets. And secondly, a brief summary of strategies that the FI plans to use to achieve their targets. And then once FIs have those targets, they can then just fill out the target submission form that is available on the SBTi website. And then they'll just need to upload that submission form on our website and reserve a slot for when the SBTi target validation service will start. In terms of the process, there'll be 2 reviewers, so a 4 eyes process there, and there'll be just a back and forth discussion in terms of questions or clarification or otherwise. And if and when the target is approved, then the targets will need to be published on the SBTi website, and then thereafter the FI will need to track its progress and report its emissions progress and actions taken on an annual basis. I think is your question here. How long does the target validation process take? So maybe just to note, the target validation function has been separated from the criteria and standard development function that Nate and I are part of. And that's just so there's the validation is an independent process from us. So not speaking on their behalf, but just generally what I've personally seen is that in terms of time, target validation process can roughly take a month or 2 from the booked time slot, but it will really depend on the number of question rounds as well as the response time. So I've seen validations that were very quick because the submission form was filled out completely and very clearly. And then response times were, next day responses. Whereas I've also seen FIs where the submission form was not very clear, and so therefore there were a lot of question rounds, and then responses might take weeks at a time. So of course, in those cases, it would take much longer. So definitely, we're going to encourage you to fill out the submission form very clearly and accurately. So yeah, once you've done that, then you're on your way to start working on achieving your targets. So with that, I'll turn it back to Nate.
Great. Thank you, Howard. So yeah, this has been a whirlwind summary of a lot of information, but the 7 steps that Howard described here explain how to get from 0 to having a published and eventually achieve science-based target to support climate stabilization. I've had a lot of excellent questions in the Q&A here, so appreciate those. And unfortunately, we didn't have time to get to all of them. We took some of the key questions, but we will be having more information that we'll provide. And one thing is for folks who want to keep up to date with the Science-Based Targets Initiative work for financial institutions, we do have a newsletter that you can subscribe to through our website. And we will be sharing recordings of this webinar, as I mentioned. For financial institutions that wish to use this, we encourage them to complete the submission form and submit as soon as possible. And we look forward to working with all of you, and thank you for your attention today. With that, I think we are done with this webinar. So thank you all.